Welcome back to the Deep Dive. Today we're cracking open the results from, well, one of the most operationally fascinating companies in the social tech space, Grindr Inc. We're analyzing their Q3 2025 earnings call, which delivered some massive surprises on profitability. But it all sits squarely beneath a cloud of corporate uncertainty.
That's absolutely right. You've got a company delivering numbers that would make, nearly any software as a service company envious. We're talking record margins, cash generation, pricing power. But the entire conversation is completely dominated by this serious governance challenge. Our mission today is to meticulously pull apart the core operational insights from all that noise and help you understand the true health and potential of this business, independent of, who might own it tomorrow.
And the immediate market reaction was explosive, for good reason.
Right.
So let's start with the headline numbers, because they really do tell a story of an operational masterclass.
Right.
Grindr reported Q3 revenue between $115.8 and $116 million. That's a nearly 30% increase year over year, and it just sailed comfortably past consensus expectations. Clear top-line momentum.
It was a very clean beat on the top line. And the discipline they showed in cost control meant the flow through to the bottom line was... well, it was phenomenal. Adjusted earnings per share came in at $0.16.
16 cents.
Yeah, which significantly surpassed the street consensus of $0.12.
Yeah.
So that's a solid 33% beat. Management framed the quarter as outstanding, and I think that margin performance is really the key highlight.
Okay, let's define that performance. When we talk about margins, just how far up the scale did they go?
This is where the story gets really structural. Adjusted EBITDA hit a record range of $54.8 to $55 million. But more importantly, the adjusted EBITDA margin reached an all-time high. We're talking 47 to 47.4%.
Wow.
That represents a 200 to 250 basis point improvement year over year. For those unfamiliar with the term, a basis point is just 1/100 of 1%. So they improved their profitability relative to revenue by over 2 full percentage points in just 12 months.
A 47% EBITDA margin is, frankly, highly unusual for a social media or a dating platform. Most of these companies spend heavily on content, moderation, constant user acquisition, just to maintain market share. Why is Grindr so efficient? What's the secret sauce here?
The secret really lies in its unique business model and these structural cost advantages. Unlike platforms that rely on user-generated content or constant influencer payments, Grindr's content, the profiles, the messages, it's all provided by the users themselves at zero cost to the company.
Right.
Their user acquisition strategy is highly fixed. They own their niche, which minimizes that massive variable marketing spend you see at all their competitors. They already scaled past the infrastructure costs, meaning that incremental revenue, like that 30% jump we just saw, it requires virtually no incremental operating expenditure. It just drops almost directly to the bottom line. That's operating leverage in its purest form.
Okay, so let's unpack how they sustained that revenue acceleration. What was the mix that drove those impressive margins?
We saw robust, high-quality growth across the board, but the mix, it reveals a key surprise. Direct revenue, which is their subscriptions paid by users, grew a very solid 25% year over year. That's predictable, sticky growth.
Okay.
However, the main source of the upside beat was indirect revenue, so advertising. And that surged by an astonishing 56% year over year.
56%.
Yeah.
In ad revenue, that's massive, especially from a business where subscriptions are the core.
Yeah.
But stepping back from the P&L for a second, what does the quality of this growth look like on the cash front? Are they generating cash as efficiently as earnings?
They are, and I'd say even more so. This is a highly cash-generative model. Grindr generated approximately $51 million in free cash flow, or FCF, in Q3. This represents a free cash flow conversion rate of about 93 to 94% of their adjusted EBITDA. When a company is converting almost every dollar of their adjusted earnings into deployable cash, that is a sign of operational mastery and minimal capital expenditure.
And they've been aggressively putting that cash to work, haven't they?
Absolutely. Management has been focused on capital returns. Year to date, they've repurchased 25.1 million shares for around $450 million. That significantly shrinks the public float. They only have about $50 million left on the current authorization. So they're actively contracting the outstanding share count at the same time they're expanding margins and increasing cash flow.
That is a powerful combination, but we have to mention the balance sheet context. They're deploying a huge amount of capital with these buybacks. How leveraged are they, especially since they're still technically GAAP loss-making?
That's a crucial point of nuance for you to understand. They remain GAAP loss-making on a trailing 12-month basis, yes, but that's primarily due to non-cash items, specifically stock-based compensation and depreciation from past transactions. The balance sheet itself is quite healthy. Net debt sits around $277 million, which is a debt-to-EBITDA leverage ratio of about 2.2x.
Which is pretty manageable.
For a high-growth subscription business, that is a very manageable level of leverage. They are not overextended, even with the heavy share repurchases.
Okay, let's transition to the user base, the engine of this monetization strategy. Grindr reported 15.1 million monthly active users, MAUs, and 1.3 million paying users. That pushes payer penetration to 8.6%, with an average revenue per user, or ARPU, of $24.70. And this is where the pricing power discussion gets really insightful.
It does, because management admitted they implemented their first subscription price increases since 2018. They targeted the Unlimited and the XTRA premium tiers. The market was sort of holding its breath, expecting a conversion dip. Instead, they noted the impact on conversion was de minimis.
De minimis. That is a fantastic word to hear if you're a shareholder. It suggests users value the product so highly they're willing to absorb price hikes without significant churn. That just screams strong pricing power.
Exactly. It confirms the value proposition has increased substantially since 2018, and it gives them huge optionality for future ARPU expansion. And furthermore, the demographics they shared really underpin this stability. They highlighted the generational impact, noting that 46% of profiles across the US and the UK are in that 18 to 29 age range.
And that generational renewal rate is just critical for long-term platform health.
It is. The younger cohorts drive the continuous engagement, they bring fresh perspectives, and they ensure the platform remains vibrant. But crucially, the older cohorts, who typically have higher disposable income and more fixed dating needs, they're the ones driving monetization. They're paying for those high-value premium tiers. It's a beautifully segmented demographic that allows for some pretty sophisticated pricing strategies.
Speaking of sophistication, let's look at the product execution. Management discussed the continued high engagement with their Right Now feature. How's that performing? And what about the necessary cost of maintaining platform health?
Right Now is succeeding in increasing the product's social surface area. About 20 to 25% of users are posting weekly. Over 75% are viewing those posts. They're also experimenting with a new mapping UI in key cities to make it even stickier. And on the integrity side, management spent time detailing their efforts on trust and safety. They are proactively removing scammers and bad actors using Gen AI fraud detection tools more and more.
While that sounds great for users, doesn't cleaning house like that sometimes weigh on the overall MAU numbers? There's this perpetual pressure in social media to report growing user counts.
Oh, it absolutely weighs on MAUs, and management was transparent about that. They framed it as a necessary cost for ecosystem health. If users don't feel safe, or if they're constantly seeing scams, long-term retention suffers dramatically. So they're willing to sacrifice some short-term MAU optics for the sake of long-term user trust and monetization stability. That tells you they're focusing on quality over quantity.
Let's pivot to the strategic vision. This is where the call went from successful to, I think, truly ambitious. Management laid out a clear AI-native ambition. What does that specifically mean in the context of dating? And how are they translating that vision into revenue?
It means embedding AI deep into the platform for 3 core functions: smarter matching, advanced safety tools, and greater personalization. And this is not just a buzzword. It's leading directly to a new high-margin revenue stream they're calling the first-class cabin.
The first-class cabin. That sounds like a significant evolution beyond the current XTRA and Unlimited tiers.
It is. This is going to be an AI-powered premium subscription tier designed specifically for their power users. The features are quite aggressive. They're planning something called A-List, which uses AI to summarize long message threads, and personalized insights, which could tell users, for example, the best time of day to post for maximum engagement. These are features only made possible by generative AI, and they're designed to solve high-friction user problems.
An AI-powered premium tier rolling out in Q2 of next year is highly ambitious. Given the regulatory landscape and the complexity of integrating Gen AI into a sensitive app like this, are we just buying into marketing hype, or is this truly an actionable feature?
The timeline is ambitious, I agree. And the market should view the short-term revenue impact cautiously. While the rollout starts next year, the full revenue acceleration isn't projected until late 2026, accelerating into 2027. But the investment is real, and the vision is clear. And the upside potential is substantial. Management anticipates converting 20 to 50% of their existing 350,000 unlimited subscribers to this new, higher-priced premium tier. Hitting even the low end of that range would provide a massive structural boost to their already high ARPU.
And all of this potential ARPU growth is underpinned by operational discipline. You mentioned OpEx control earlier.
That's the critical link. Operating expenses, excluding cost of goods sold, grew only 9% year over year. Think about that. Revenue is up 30%, but OpEx is up less than 10%. This intense control ensures that nearly all the revenue upside from new features like the first-class cabin and pricing power drops directly to that 47% bottom line. It just reinforces the entire margin profile.
We should also dedicate some time to the international strategy, which remains a huge untapped growth lever. It looks like they're applying a highly localized approach, not a one-size-fits-all model.
They absolutely are. They've segmented the opportunity into 3 clear buckets based on maturity and market need. Bucket 1 is increasing pay penetration in economically advanced countries, like in Europe, where subscription rates still lag behind the US and UK. The model's proven there, it just needs tactical execution.
And the second bucket?
That's pure MAU growth. They're driving brand awareness in high user count countries like Brazil and the Philippines. These markets offer immense scale potential, even if the ARPU starts lower.
And the third, which sounds the most strategically challenging, is that long-term localization effort in markets like India. What unique needs are they addressing there?
Yeah, this bucket focuses on high-complexity, high-growth markets where discretion and social stigma are paramount. For users in India and similar regions, privacy isn't a preference, it's a necessity. Management discussed addressing unique needs like, for instance, potentially using AI-generated photos or extremely sophisticated privacy controls to ensure safety and allow users to engage without fear of exposure. That level of product localization shows a real long-term commitment to capturing those huge growth markets.
Okay, so we've established the execution, the margins, the future product pipeline are all pristine and robust. Now we have to address the massive capital markets uncertainty that is overshadowing this record quarter, the governance overhang.
This is the existential challenge. The earnings call took place just after a non-binding $18 per share take-private proposal was formalized. It came from the majority shareholders, Ray Zage and James Liu, who collectively own over 60% of the company. The material implication here is that James Liu resigned the night before the earnings call specifically to focus on pursuing that bid. That signals very serious intent.
So what's the official process now, and how is the market reacting to $18, especially given the quarter we just dissected?
A special committee of independent, disinterested directors is currently reviewing the bid. Their job is critical. They have to determine if $18 is a fair price for all minority shareholders, particularly in light of the new guidance and the 47% margin. And critically, multiple law firms have already announced fiduciary duty and fairness investigations surrounding the proposal.
And that tells you everything you need to know about the market skepticism.
It does. The stock jumped 11% post-earnings, but it still closed around $15.09. That sits significantly below the $18 offer price. This discount signals that investors are assigning a high degree of uncertainty to the whole process. It's the market effectively saying, we believe the company is intrinsically worth more, but we have to discount that value heavily because the majority owners might force through a lowball offer. And this sentiment is further confirmed by the high short interest sitting at around 33% of the float.
That market pricing $3 below the offer is a clear indicator that the street does not believe $18 reflects the true intrinsic value of a company growing at 26% with 47% margins and a new AI product roadmap.
Exactly. And that brings us to our segment for advanced listeners who appreciate analyzing asymmetrical risk-reward scenarios within this complex context.
This is not financial advice. We are not recommending you buy or sell anything. But let's talk about the highly leveraged but plausible trade idea this governance noise creates.
Given the record fundamentals and the strong signal from the market that $18 is likely too low, we pitch a high-leverage, medium-term trade betting against the current $18 take-private offer succeeding at that price.
So how would you structure that bet? You'd need high leverage to capitalize on any potential upside.
The structure would be to buy long-dated call options, looking 9 to 12 months out, with the strike price above the current $18 proposal, so say a $20 or a $22 strike. This acknowledges that the current stock price is depressed purely by deal uncertainty, not fundamentals.
What are the 2 core scenarios where this high-risk bet could pay off substantially?
Okay, scenario 1. The special committee successfully defends minority shareholder rights and forces the majority owners to sweeten the bid significantly. So moving the offer to $20, $22, or higher to reflect the actual growth and margin profile we just discussed. Those out-of-the-money calls would instantly become highly valuable. And scenario 2, the deal is withdrawn altogether, maybe due to governance concerns, failure to agree on a price, or public pushback. If the deal collapses, the market will be forced to re-rate the stock purely on its fundamentals. Before this quarter, consensus 12-month targets were already forecasting a value about 60% above the stock's pre-earnings. Quote, if that governance cloud disappears, the stock flies past $18 on intrinsic value alone, making those calls hugely profitable. It's a binary outcome, driven by a strong underlying business trapped by a capital markets event.
Fascinating analysis. So what does this all mean for the listener as a final takeaway?
I think the key insight is duality. On one hand, Grindr is executing a high-margin, high-growth plan, 26% plus revenue growth paired with 47% margins. It's built solidly on proven pricing power and an aggressive first-mover push into AI monetization. But the near-term story is completely dominated by whether the existing owners will be allowed to buy the company back at a price that, well, it appears significantly discounted relative to the quality of the assets.
And we leave you with this provocative thought to consider. If the majority owners, who have the deepest insight into the operational numbers and the future AI roadmap, are already willing to pay $18 per share now, what is the true fundamental value of this business once that new AI-powered first-class cabin premium tier begins accelerating revenue in 2027? We'll leave you with that question.